It's the higher standard, everybody. Welcome back to the show. Let's go. Let's get the can pop going right out the gate. Welcome back. It's going to be a sexy day today. We got a lot to talk about and not a whole lot of time. Jobs reports came in and, well, they finally actually look right for once. They match how we all feel, which does beg the question of how and where these were being manipulated for such a long period of time and why all of a sudden the honesty. But who cares? It now starts to match reality. Then, of course, we got to talk a little bit about crude oil, geopolitical conflict, and the market's reaction, which ain't a good one. This is all the things we should have saw on Monday, which then leads me to a conclusion that the markets have to be manipulated so people can get money out or move them around to safer havens, because this was the logical thing that happened at the start of the week, not the end of the week. So one bad day to printing jobs should not have done this entirely on its own, yet here we are anyway. If you're new to the show, welcome. We try to give you everything you get on CNBC within 1 hour of time. We're also going to touch on the behavioral economics piece that popular mainstream media does not typically touch on. That includes X and Instagram. So stay tuned to the back half of the show where we spend a lot more time looking at that. We do incorporate AI into our models. We use Claude and a couple of different other models to do a little bit of analysis on the show, not only real-time analysis for forecast based on the current market status, but also to tell us what is in fact trending topics on social media. Give us an AI breakdown of it, because the entire aim of the show is to be completely politically neutral and just look straight at the numbers, the economics, the mathematics. That's what makes us a bit different here. We don't have a bias and no reason to be biased for that matter. We call out stupid no matter what party you subscribe to. And if you want to support the effort, the initiative here, you can go to www.joinfridays.com, enter the code HIGHER, and you will get $100 off your first order. Everything from GLP-1s to make you look sexier to NAD Plus to make you think and be younger. That being said, I currently take both, and they also offer a whole hell of a lot more. You can do it with an actual discussion with a doctor, or you can do it all electronically via email and text message, which I found to be very cool. That being said, let us jump into the show. Obviously, the market status today is... Oh, wait, hold on a second. What's going on here? That's weird. My camera's not switching the way it should be. What? That's... Ha! Let's try that again, shall we, kids? Well, that didn't work. I will figure out that at some point in time in the future. But for right now, let's look at the market status. I will just pop over here while we do this. Market status today is not a good one. We are finally in a forced selling position. And because of the forced selling position that we find ourselves in right now, you can see that we are, in fact, this is not going to work for me with this whole thing not switching the way that it's supposed to be. And I think the only way to fix it, frankly, is going to be to go up here and see if I can get this to quit and restart midstream. Oof, this could be bad. Hold on a second, guys. If this doesn't pop back on and work, then we might have an ugly day. Hold on a second. Let's go back here to the main shot here. Let's go back to our status. Nope, not working. That's going to be ugly. Okay, what we're going to have to do is we're going to work around this today. So this is our market liquid status. We're in a forced selling position the first time this has happened. So we are not going to be in a rally in any way stretch of the imagination. We are literally going full risk off, and this is the worst case event scenario, which is good for me in that the models we've been testing for such a prolonged period of time do actually work. Keep an eye on this bar down here at the very bottom. This bar is going to be indicative of, let's go this way here. This bar is going to be indicative of what the market is doing at all times. So keep an eye on this as we go sector by sector for our analysis here. And because this isn't working, I'm going to go straight into the sectors because you need to see what is going on. But before we do that, let's go to the synthetic volatility index. This is the synthetic volatility index. It is our variant of the VIX. We are still in a normal position, even though we're not seeing a whole lot of confidence in the market. And that's largely because of the way the index reads. It looks at things like intraday range stretch, graph analysis, cross-market volatility. Across the market, we seem to be okay, but we are in a forced selling position. So yes, that does make sense. And I'll explain to you and show you why really quickly here when I go to the VIX. So let me pop this up real quick. I'm going to go over to CNBC, and I don't even know if this is going to work actually either. If I go to the screen, yeah, it's not even going to share the screen view. Wow. That's going to be a problem today, isn't it? I don't know. The best thing to do here is to end the stream and start back up, or to, very, very difficult to share a screen that I cannot share. That has never happened before. Models work, but the stream's not. Let's try one more thing, and if it doesn't work, then I'm going to cry a little bit on the inside. But let's see if I can get it to work here. Let's see here. Live production. I'll quit the stream deck. Forgive me while I troubleshoot and see what I can get going here. All right. All right. Let's see if this works. Nope. It's not working. I know how to fix this, and unfortunately, it ain't a good one. All right, what we're going to do is we're going to... I don't want to stop and restart, though. What to do, what to do. Who's in the chat? Who's here? Fancy Faces, by the way, let us create a tattoo for the show. Airbrush on the team. I would love to do that, by the way. Let's see what I can get going here on the other side of things. I might have to stop and restart the stream. What up, Saeed? What up? How you doing? Maybe made it on time. Let's go. Yeah, you made it on time for the only episode I've ever had a technical challenge where I can't really switch between these. Let me see if I can do it manually with... I might be able to do this manually. Let me see here. If I launch the interface, I might be able to get over here and do... let me see. Yeah, no, it's not controlling it. Damn. Let me see here. Status. Elgato Stream Deck online. Rescan USB. Let me see if I can do that here real quick. Plugin has been enabled. Okay, cool. Surfaces, buttons, connections, and now we know why. Okay, I can fix this part. Give me 1 second while I fix. This might take me off video for a second, so bear with me. There we go. All right, so I know you guys can hear me. I apologize. Let me go back out here to the outputs. So I'll go to the program view. This should bring you guys back in here in just a moment. There we go. Hey, we're back, kids. We're back. We're back. All right, let's get back to the show. I apologize for the bit of an inconvenience there. All right, there we go. So risk off position for selling. Not a good start today. Synthetic volatility index appears to be normal. Let's get over here to the markets. I'm going to show you the VIX from CNBC. VIX. There we go. We're going to jump in, take a look at what the market is showing you here. All right. It has been a strange day. All right. So if we go over here, that should work just fine now. Always one more challenge. Hold on. I got you. It's coming back. And there it is. All right. So that is your volatility index for the day. The VIX is above 20. You know, if you watch the show at any period of time, that anything above 20 is considered to be heightened risk in my mind. So the VIX is elevated. Our synthetic volatility index does not seem to share the same thing, which means, and if you know how our models work here, that means that this is somewhat intentional trading activity, not necessarily market volatility purely. And I will explain more about that in the upcoming segment. But first, let's go here. Liquidity, believe it or not, has actually improved. And this is because the Fed has been pumping liquidity into the system. So what really drove the market today was the headline risk and the massive jobs miss, which we're going to spend some time talking about and getting into here. So you have the Fed balance sheet 93 fresh with liquidity. You did see the Treasury account boom a whole lot. They did say they were going to do this as part of the non-QE QE. So we are actually starting to see that liquidity run through the system. This does tap into St. Louis Fed data. When you subtract Fed balance minus repo and Treasury account, you get a number and a code that gives us a tense policy here. So we are seeing more liquidity in the system vis-a-vis the Fed, but this is not stopping the overall status of the market being in a risk off in a very tense capital fleeting position because people are very worried about the status of the economy and the geopolitical conflict. That is obvious. Before I get into the meat and potatoes of the episode, let's get into a little bit of the affordability crisis. Home affordability is still stretched. You're going to see the 10 years and a lot of the Treasury spike today. I think you need to understand why. We're going to spend some time talking about why the 10-year is doing that. And a great example of this, you need to look no further than some of the conversation I have had with people. So it did spike. It is showing a bit down right now, but I'm going to show it to you anyway. This is your 411 number. That has gone up pretty dramatically in the last couple of days. Dramatically is, tenths of basis points in this particular instance. But let's look at it over the course of the 1 day. There you are, 1 day, it dropped down. And see, it spiked up here at about 418. It's come back down, so a little bit of response, I think, there is good. But if you look at over the course of a 5-day period of time, you can see that this is gradually increased, and this will have an impact in increasing mortgage rates. So home affordability vis-a-vis this is going to stretch. I think over the next couple of months, you're going to see a blip from the lower when the mortgage rates dip below 6%. But that window of time is gone, at least for the near term, which is a normal response. And the email that I got today, which is indicative of how this works, is I got an email from somebody who's retired who watches the show pretty regularly, and she said, hey, you know what? Time for me to go into bonds. This market's not safe for me. I'm going to go long-term into bonds. And then as you go longer term into bonds, you're going to drive that price up because the demand is going up and the supply is staying the same. Classic supply and demand argument. We're also going to talk a little bit about Walmart down here a little bit later on in the show. So keep an eye on the moving ticker. They are down for the day, but I think that there's going to be some interesting things between Walmart and Target. There's been some tension there. If you've watched the show for any period, you know that we talk a lot about that. Shall we get into, before we get into the sectors, let's get into the calendar, okay? This is the macro week of Fed events. Today, you saw a lot of this causing problems, most notably the unemployment rate. This number went up. It went up big time. We can talk a lot about the retail sales coming up, some of the mortgage data coming up next week, and some of this other information, 30-year mortgage rate, for example, but that is going to be nowhere near as important as what we spend our time talking about in the sectors today. The home builders are down. You're going to find a reoccurring trend because, look, we are in a risk-off, fleeting liquidity position market today. That should be something you're aware of. It should be something that concerns you a great deal. Whether this is long-term and near-term, that remains to be seen. If you're in the comments, tell me how you feel. I want to hear all about it. And if you haven't watched the show before, let me help you help yourself. You actually can be included in the show. I bring the comments real time. Maria Rodriguez, yes, made it on time. Let's go. Thank you. And I apologize for the technical difficulties to stop this thing off. It was an ugly start to the day. And of course, it would not be a show without my guy here. For our new investing listeners, risk off position means playing it safer with your money and shift toward lower volatility and safer holdings. That is correct. Look at me. I left my energy drinks in the car today. It's been a very off day for me. If my wife were here, she would say, Mercury's in retrograde, and because of that, we are seeing a lot of technical glitches in electronic equipment that we familiarly use. I say no, but whatever. It's all good. All right, and if you are watching on Instagram, I cannot bring your comments into the show, but I will definitely comment from time to time. Fancy Faces, I am absolutely all about hearing about what you can do for the face, to paint our faces, and I will do a full show with face paint anytime you want, and we'll put you down here as well so you can get some support for your product. For all my real estate agents, mortgage professionals, realtors out there who watch, this is going to be an important thing for your clients. They're going to want to know, should they lock rates? Should they not lock rates? What should they do, especially if they're refinancing or if they're looking to buy a home? I think if you're looking to buy a home, the best time to buy is always right now. The incremental difference in the mortgage rates between yesterday and today, let's just say last week, high 5% versus low 6% is not meaningfully different. If somebody actually needs the utility of buying a home, they should buy. But don't take my word for it. Let's get into those sectors again. DR Horton, Lennar, Pulte Group, Toll Brothers, NVR, the major home builders are showing signs of weakness today, as well as the market. You got interest rates going up, and this is, in fact, rate-sensitive demand. I think you are going to get a boost in the next couple of months when you hear about some of their numbers coming out. Reminder, housing is a lagging indicator, so expect there to see some information and data that comes out that show we saw a slight mortgage and purchase boost in response to the sub 6% rates. But the mortgage lock-in effect, in my mind, is becoming increasingly more of a marketing narrative and not a reality. And that's because you're starting to see more and more Americans with mortgage rates in the 5 and 6% range as opposed to the 3% and below range, which we saw during the pandemic. Let's jump over to some of the other sectors, and you're going to find this to be a really ugly sector day. So if you're sensitive and you've got a sensitive constitution, hold on tight, okay? It's going to be a bumpy ride. The banks are, in fact, down. This is the credit conditions of the market, and I'm looking at private credit markets, and I'm looking at a lot of things that we're seeing here. Anytime you see this, you see a constant fear of credit conditions and things that could, in fact, deteriorate, causing there to be not only a run on banks, but certainly a financial strain on banks, okay? Now, I think a run is an extreme, impossible spectrum at this particular juncture in time, unless everybody's aware of something that I'm not. But as a former banker, I find that highly improbable. So you're going to see the bankers come under strain. Now, I do think this is still a sector that we think is favorable over the course of the next couple of years. We've said on the show many times, and I continue to stand by that what we have here in the banking sector is the opportunity for them to increase net interest margin. They are going to continue to grow and scale. But I need to pose a serious question to all of you who are going to be watching this market, okay? So let's go to the side view so you can get that serious angle of me. Hey there, guy. Yeah, so here's the problem for banks, okay? This is that intimate conversation moment with you and me. If you're a small community regional bank, it's going to be harder and harder to compete with the larger banks. Yes, vibe coding makes it easier to develop and development costs will go down, but you still have the regulatory risk, the burden, and the scales of economy that the larger banks are just more sophisticated and financially able to handle. So you're going to see a lot of M&A, merger and acquisition activity in the small community regional banks. Those are going to get swooped up by the larger super regionals and larger banks. So if you want a possible payout or opportunity to get some investment structure going there, you can look at the community regionals. KBRE, the small bank indices that tracks this, is down heavily today in large part because you see the banking activity that we saw there already down. But we need to face a harsh reality. Oracle, which we're going to cover here in a couple moments, just announced, or at least the rumor is that they're going to lay off tens of thousands of people to free up billions of dollars because they're paying these people salaries and now they have more efficiency. And this is part of an AI conversation, which does dovetail nicely into the jobs rhetoric, which is driving the market down heavily today. That rumor came out just yesterday, ahead of the jobs numbers today, which were also exceedingly grim. If you're in the bank sector and you make money in the traditional sense by making loans at a percent and paying on deposits at a percent, right? Okay, the difference between these is something called NIM, net interest margin. Okay? And NIM, well, that's the profit margin. And in the context of the banking world, if you get a 2% net interest margin, you're generally a profitable bank. Anything more or less is great. But that's your main source of revenue for all banks across the country. Now, you can have investment banking, fee-related services, banking as a service. There's all sorts of other ways you can make money. But that is the spread, the profit margin. Now, how can banks retain more of this profit margin? Well, they can automate. They can use a little something called AI. And because of this, you are going to see more and more financial jobs, underwriters, financial analysts impacted by AI. And you're going to see banks, particularly large banks, implement AI faster than everybody else can because they can get around the regulatory threshold and hurdles in such a way that they can move faster than the small community regional banks. So you're going to see banks become more profitable over time, whether you like it or not, and you're going to see less hiring and less staffing to do it over time. So that is a grim and unfortunate reality, especially because I came up in the banking sector. I don't like seeing it. I think a lot of the analysts cut their teeth. I did, certainly working as a teller, which are going to wind up being extinct, it looks like, in the not too distant future. And then you have analyst jobs in the beginning. I did that. You underwrite. I did that. You process loans. I did that. And I don't know how much of that in a digital world is going to continue to be there. And I don't know how you can get those basic core understanding elements in jobs anymore if those front end jobs are largely done by AI and then supervised by somebody with experience. So it does beg a question, and it does make one worry. Okay, let's get into commercial real estate. For those of you who watched my stories on social media yesterday, I spent some time looking at a bunch of construction projects, almost all of them of which were multifamily projects. I did look at one commercial one that had some environmental risks that I want to take a look at. I am a big believer in this market. This is where the bulk of my career has been. I do think the real estate investment trusts, or the REITs, will continue to perform. Stock market is showing this to be strength here. I think as data centers move into what was otherwise office space, and you start to see some crossover there, I think you're going to start to see these businesses and these REITs perform better. Now, there is some risk. What happens to office space? Is return to office really going to happen? Well, I think a permanent departure from office might happen with the AI sphere here, and with some of the jobs numbers, we seem to be seeing a little bit of that because, again, record profitability by companies, and now hiring seems to be exactly what we thought it was, but the market wasn't acknowledging it now, if that makes sense. But we'll get there, so bear with. Mega caps. All the mega caps. Apple, Microsoft, Nvidia, Amazon, and Alphabet all down on the day. So you're not going to get any tech-led rally benefits. It is not uncommon to see the Mag 7 pull the S&P 500 as a whole back up. You're not getting that today. It is a true risk-off position. And what's interesting to note about the true risk-off position of the market today, and if you're Syed, if you're out there, this is your moment to shine, brother. This is your moment to take the victory lap. Traditionally speaking, when the market goes risk off, you see gold blow up, but then you see cryptocurrency, i.e. Bitcoin, go up as well. And now you're not. You're actually seeing a full flight from risk. And what that means overall, broadly, unless there's a different catalyst for this, which I'm not aware of, and I don't think there is based on my research this morning, if the market is going risk off in this particular environment, it's going to pull away from assets that it believes to be volatile and has market sensitivity risk. Liquidity is going to go into a position where they feel it's safe for whatever happens geopolitically and from a recessionary standpoint here fiscally. So I think there's no argument to be made at all that there is volatility in Bitcoin. You can't lose almost half your value in the last 6-7 months and not have that fear be there. But this was always thought to be a hedge against inflation. And it does not appear that same rhetoric is indicative in the price action that we're seeing here. Not to say that Bitcoin isn't an investment and that it won't go to God knows how much, but certainly it's different. Now, if you look at gold, gold is performing up on the day. Gold continues to be a perceived hedge against inflation. Now, there is no true hedge against inflation. The only real hedge against inflation is to continue investing, dollar cost averaging over time, because everything will move. But this is the behavioral economics that you cannot ignore. If cryptocurrency, i.e. Bitcoin, were considered to be a hedge against inflation, that should have moved in tandem here. I think what the market is effectively saying is they feel that the risk profile, probably because there's so many institutional investors in crypto, aligns or is analogous to the stock market. So when you see people move from the stock market, they're going to move from crypto and they're going to go into gold and they're going to go into cash and they're going to go into bonds, which is why you're going to see the market change and in fact move the way that it has today. So these are all actions that I think are rational. Well, the only part that's shocking to me is that we've had an irrational market for such a prolonged period of time. So certainly a strange development there as far as I'm concerned. Let's finish up with the sectors here. The consumer sector we're going to spend some time on today because I think there's an important and meaningful thing here. Over the course of the last couple of years, Walmart has effectively invested way more in technology and kicked Target's ass up and down the sidewalk. Now, if you've heard me on previous shows, you know that I'm a big believer in the consumer health segment, particularly these companies. Walmart, Target, Costco, Home Depot, and Dollar General, I think will perform better, particularly as consumer discretionary spending gets more tight. People will spend less money eating out, less money buying the expensive stuff, and more money buying the core essentials, which generally come from these stores in my experience. Again, I'm using the word my experience to protect myself because that's just a lawyer in me. But I do think some interesting things are going to happen with Target. Over the last couple of years, Target has not performed well. They just have a new CEO coming in. And one of the things that Target's doing is they have a data selling service where they're selling consumer behavioral data out. And that's just an additional revenue stream. It's a multi-billion-dollar business where you're telling the world, the market, hey, I'm selling you data based on that tells you how consumers perform. That's really meaningful. Walmart had really invested in going head-to-head with a company that you might have heard of, Amazon. And because of that, they've seemed to see some growth. I think that's also in parallel as a good proxy for Amazon's growth because they've really moved to that e-commerce, kind of position where Target failed at that. So I'm going to give you an example using some chart work because I know how much people love the chart work on that here shortly, which tells you a little bit about what that looks like. Let me get over to the chart work section. My apologies. All right, so I'm going to go to TGT. I'm going to generate a chart and I'm going to share this with you here. Let's take a look at a couple different perspectives here. This is Target today. They are up today, which is a good trend. I think that's indicative of some of the things I just talked to you about. But certainly, if you look at the last 5 days, again, very healthy. But let's look out a little longer. There you go. So lots of peaks and valleys, lots of dips down, and now we're starting to see a recovery. So this is part of what I think they are going to be. I think they're going to be a good recovery story. I think the new CEO is well positioned for that. And I do think this particular sector of consumer health is, let me be clear here. The consumer health is not good. Discretionary spending is going to get tight. But generally speaking, these companies do well when that is the economic environment, the zeitgeist that we're in. So this is indicative of consumer health, but it does not necessarily mean because these are doing well that the consumer is healthy, if that makes sense. I just think that's where more directed spending goes. So just to clarify the point there a little bit, I don't want anybody getting at me in the comments because that happens quite a great deal. Let's go to the industrials. I do not expect good performance here. All down. Caterpillar, Deere, General Electric, Union Pacific, 3M, all down. All expected in a risk-off liquidity market. Energy is going to be mixed because you still need energy to power all these things. Exxon, Chevron, Conoco, Schlumberger, EOG Resources. I think the near-term story as it relates to oil is going to be the oil is going to be very expensive. We see oil over $90 a barrel. As a matter of fact, I haven't checked oil today yet, but you ready? It's scary. There you go. Whoa. Over $90 a barrel. I did call this. If you've been watching the social channels, including my stories on Instagram or the feeds on X and Threads and LinkedIn, this was something that was predictable. You can see the spike here popping up a whole lot. I'm going to clear the chart off a little bit. Let's take a look at some chart work. This is oil at $90 a barrel. We did say this was going to happen on the show. We did say that it was going to pop up at least to the mid-70s and most likely, depending on the headline rhetoric, that we were going to see it pop up into the 80s. 90 was not something that I saw coming, but now we're hearing the Middle East say that you could approach $100 a barrel. Now, I should say that $100 a barrel is not an unprecedented territory. So I bring you the 5-year chart in order to give you this perspective. This is literally from June of 2022, oil hit $120 a barrel. So if everybody's telling you this could go up a great deal, yeah, it could. But again, context here, if it were to go up above 120, I think you would be in an unprecedented set of circumstances. And certainly the longer any type of war goes on, the longer this could happen. Now, the government has said they were going to backstop this. They did say they're going to provide insurance because Lloyd's of London pulled out. And they did say they were going to do a couple things. But none of this is meaningful until oil starts really moving again. To finish off the sector analysis, the defensives. Are you ready? There you go. Procter & Gamble, Coca-Cola, Johnson & Johnson, NextEra Energy, Duke Energy. The energy companies are up. These are negligible losses on the day. As the day persists, if we don't see a bit of a bounce back in the markets, I think you can expect to see these finish a little bit more positive or if not flat on the day. We do feel like this is where the money goes when it's going into risk off and liquidation. You want to stay in the markets. You go into capital preservation mode. You're going into these stocks here. That's at least been my experience, as good or bad, as ugly as it is. Now I'll go to the comments. Who's out there? What up, Vic Ramirez, my guy? Yesenia, Utah Realtor, how you doing? Let's see who else we got here. Lots of people in the chat, lots of different places. On YouTube, we tend to get a lot of new viewers watching the show, not a lot of people commenting on the show. And you know what? That's okay. I appreciate you guys coming and checking us out. Not everybody has to engage quite the same way, but certainly we do love and appreciate it. Let's see here. Oh, my guy, Samson, should we jump in more today on stock market due to red? Well, I mean, that's one way to play it. I don't think so personally. Not today. I think you need a little more fodder. I think we've seen some really interesting dynamics. We know that Iran historically has used disinformation campaigns on social media to control a narrative. Certainly, all foreign states, Israel has done this as well. The United States does it as well. So we saw a lot of different things on social platforms about there being peace talks, not peace talks. Well, the White House has said they're not going to do anything unless there's an unconditional surrender, at least right now. So, because of that, I think that you're going to see this ramp up and heat up more. And until such time as there's a reason to feel that the economy is going to improve, I don't know that you do that. And I'm not just talking about the geopolitical conflict. That's only one portion of what's really driving this today. The other portion of it is a much bigger problem that I think is going to be frankly sustained for a prolonged period of time. And let's not waste any time getting into it. I think it's an important conversation to have. The U.S. economy lost 92,000 jobs in February, and the unemployment rose to 4.4%. It was down to 4.3%, I believe. So you saw this jump back up. Now, you should recall that last month we got 126K jobs plus, right? That's probably, let me make that actually look like English. 126K plus jobs were added to the economy in January. And I lost my mind. I called bullshit on that right away. And the job numbers have been wrong for a long period of time. Nothing seems accurate. They expected plus 55K jobs this month. What they got was minus 92K. Okay. That is a pretty big swing. Okay. So effectively, you ate up almost all the jobs here. And when you start looking at the data, which we'll get into here, healthcare, which led the way the previous report, had the most losses. So what the hell is going on here? Hiring at U.S. businesses unexpectedly plunged last month as employers shed an estimated 92,000 jobs, according to new data released Friday by the Bureau of Labor Statistics, the same bureau that reported last time. Unemployment rate edged higher to 4.4% from 4.3%. See, I'm not always wrong. Economists were expecting job growth to slow somewhat after a surprisingly strong January because those January numbers were fugazi. They were bullshit, okay? In part due to major labor strike in healthcare workers and a deep cold snap that may hit U.S. states. The consensus estimates were for a net gain of 60,000 and the unemployment rate to hold steady, FactSet estimates show. I'm quoting now, we had a labor market that nearly froze last year, and it seemed to show some signs of thawing, which made it slushy at best, Diane Swonk, chief economist at KPMG US, told CNN in an interview today. Not a good set of circumstances if you've been watching the job market and if you think that AI isn't going to disrupt things. Of course, this would not be our show if we didn't look at some chart work here. These bars, purple, show you the positive gains. The yellow shows you the negatives, the drop-offs, right? Okay, so U.S. jobs lost in February and the unemployment rate increased 4.4%. And these numbers here, I don't have to be a good mathematician to tell you that these numbers that are where they're being lost here visually in the yellow seem to eclipse the numbers that are being gained here in the purple. So we're seeing a net job loss, frankly, since June of last year is kind of the numbers that I'm looking at here. There might be an incremental, par, but I'm not feeling pretty comfortable with the way this looks, right? If anything, we saw healthy job growth, and now we're starting to see the beginning of what looks like job deterioration. Now, of course, we can debate the semantics here all you want, but here's the truth, okay? Jobs, prices, okay? Those are the Fed's dual mandates. Stability of employment, jobs, stability of prices, price stability, okay? This is inflation, right? And this is jobs, unemployment going up. There is a problem for the Fed looming. These two things are in contention now, and the market seems to be very concerned. Do you cut rates? Do you increase rates? These are questions, and they're going to be talked about a whole lot in the days and weeks to come. Of course, job market today, Dow, S&P 500, NASDAQ sinks after job report surprise as oil jumps. And it wasn't just the jobs market. Oil also popped off to this $90 a gallon, and you had the Saudis come out and say they expect to see about 100 or more dollars a barrel. And then, of course, this comment really caught me off guard. Meanwhile, oil prices climbed after Qatar's energy minister predicted the war on Iran would force Gulf exporters to shut off production. So our guarantees of Lloyd's of London and the Navy supporting them doesn't help the production issue here. Within days, and warned it could spur prices to $150 a barrel. And we just covered the historic proxy there at $120 a barrel. So Therein lies a big problem. At the same time, the Wall Street Journal reported that Kuwait has begun cutting production. So already cutting it. All right. President Trump said Friday that its only path to resolution in Iran is a, quote, unconditional surrender. So all the rhetoric about there being some type of work here, at least, does not appear to be moving fast, I guess, expeditiously. Let's go over to our AI models. If you're not familiar with our show, these models will scan and review the interwebs. Most notably, we rely heavily on Instagram and X. It'll come up with the top headlines of the day. This is not done by me. This is all AI driven. It's going to give you the sentiment. It's going to give you an AI interpretation, and then it's going to tell you how much of a spike in mention it is, what the engagement rate on this topic is, how volatile it may be, if there's an elevated or not normalized risk level, and of course, the energy, the sector which will be impacted by this. The first one, of course, oil price surge is top of the list, and it should come as no surprise to anybody that this is a top of the list thing. If you see oil surging the way that it has, and you see some of the comments that some of the subject matter experts in Qatar and Kuwait are making reference to here, you've got a reason to worry. I'm actually stunned this did not happen on Monday. I'm stunned it didn't happen on Tuesday. And I'm blown away that this started to happen on Thursday, the week after we declared a war. The level of plausible deniability that people have in just accepting that the market is going to have a down session is wild. But 14 years artificial interest rate deflation, people get really arrogant, and arrogance comes out in the markets, and that's what we have here. WTI crude oil prices surged above $92 a barrel, up 16% in a single day and 66% since December, making potentially the largest weekly gain on record since 1982. AI's insight here, historic short squeeze suggests potential for sharp reversal once geopolitical tensions ease. Consider energy stock profit taking opportunities. So if you're in the energy sector and they're going to make a whole lot of money because of this in the not too distant future, you take those profits off the table. If you're somebody who likes to play the option game and you want to short, you could short the price of crude oil if you think you have an idea of when or if this war is going to end. But I would urge caution in how you do that. And you might be saying, well, why? Well, let me show you. There has been some rhetoric in the Kalshi markets. Kalshi is now facing a class action lawsuit for refusing to pay out about $54 million in winnings to users who bet on the death of the Iranian supreme leader. The platform invoked a death carve-out provision, arguing that it does not allow transactions directly tied to death and is instead settling based on the price before his death. So you're starting to see some pretty interesting things happen in these prediction markets. I found that to be interesting and strange from a company who literally expressed that they were interested in, they had no problem with insider trading, and we saw a lot of that clearly happening. Prediction markets draw down. You heard it all from me already, but certainly that's going to be interesting. So if you're going to place your bets, do it with stock options and puts. Don't do it on a prediction market because I don't think the money is going to be paid out and at least guaranteed. Earlier this week, prediction markets rival Polymarket faced heated backlash from Democratic lawmakers after 6 suspected insiders made $1.2 million on contracts tied to the strike on Iran, including an alleged $550,000 windfall related to Khomeini's death. Yeah, this is American commercial immorality on steroids, Murphy told the Washington Press, adding that prediction markets have created more of a dystopian world. Well, yeah, so is AI, but we're all ignoring that now? Is that what we're doing? Is that what we're going to do? We're just going to ignore and pick and choose what we want to look at and why? I don't think you should. Number 2, Iran geopolitical escalation is one of the top trending topics here. Number 2 on the social sphere, escalating tensions with Iran, including leadership delays, EU targeting threats, and Trump's call for unconditional surrender driving energy and market volatility, hence the price in oil in part. Historical patterns suggest conflicts lasting 12 days based on previous cycles. Defense and energy sectors likely to benefit short term. So I've heard different conversations saying this could go in through September. I've heard a lot of different rhetoric here. AI seems to suggest that 12 days is the historical cycle for something like this. Whether we get boots on the ground or not, I think will change that dramatically. Of course, this is the number 3 topic on on the social sphere. Fed rate cut pressure. Fed Governor Murin, who has always been bullish as hell on the idea that rate cuts are needed, expects to dissent if rates aren't cut this month. They won't be. Okay. Citing February job losses are supportive evidence for monetary easing. Hawkish Fed members remain resistant until job loss claims break meaningfully. Rate cut expectations may be premature despite dovish dissent. I think that is an absolutely accurate statement. I don't think you're going to get a Fed rate cut. I know for a fact the probabilities aren't in that favor, and he can say whatever he wants to. You saw it go from 4.3% to 4.4%. It was a meaningful and big miss for sure. But don't take my word for it. Let's go to the markets. This is the Atlanta Fed's Fed Watch. I'm sorry, this is CME Group's Fed Watch tool. It went from 97% probability of no rate cuts down to 95.6% probability of rate cut. You've seen a 2% bump from literally 2%, 2-point-ish percent to 4.4%. But so, yeah, not a meaningful increase in probabilities of a rate cut. And ironically, you can still bet on Kalshi and Poly markets on the probability and the chances of a rate cut, even though you've got prediction markets like this and Bloomberg's world interest rate probability, which is kind of a strange thing when you think about the context of that you have probabilities, and this gets more and more accurate historically as you get closer to the rate cut. So I guess it's an odds game, but you know that's out there. Just throwing it out there if somebody wants to ever play that game. BlackRock Credit Fund Crisis. This is an interesting one. We're going to spend some time here talking about this. I posted a little bit about it here. They've limited their ability to withdraw. Typically speaking, it's up to 5% per quarter, I believe. Private credit liquidity issues could spread broader alternative investment sector. Traditional REITs and liquidity credit funds may benefit from rotation. Basically saying that people are going to go from these private credit funds, BlackRock being the biggest one here, into other sectors, and REITs, real estate investment trusts, like I talked about previously, and liquidity credit funds could, in fact, be liquid credit funds where they can put their money in, pull it out whenever they want to. Could be, I guess, the heroes or the benefactors of this. Commodity squeeze supply also on there, and then housing affordability debate. Always there. Political rhetoric around the housing affordability solutions faces skepticism, while mortgage rates and inventory levels remain a key market driver. AI's input here has housing inventory at 1.22 million versus normal 2 to 2.5 million suggests structural shortages persist. Accurate, but it is not the biggest factor in home price affordability. In the comments, I'm sure I'll get some hate for that statement. Credit channels more impactful than policy rhetoric for sector performance. That's right. That's right. Credit factors are, in fact, more important for that. Okay. I could go into the forecast model, but because we have some stuff I want to get into today from a social media perspective, I want to spend some time looking at some of the details here and talking to you guys about that. So I'm going to forego the forecast model because we're in a bit of an off market here. Hey, people who own EVs right now. Yeah, Pagemon would probably laugh and call them names, but it's funny. California gas prices could possibly surge over $8 per gallon. There's a whole summer mix of oil that goes into California's audience play, as well as the current price per barrel, which will also further serve to drive the price up. So yes, Californians expect higher prices at the pump. That is coming. Jobs bloodbath. Should we listen to some of the rhetoric here? MAGA is stunned. Okay, this is a political narrative, so I don't want to go there, but I do want to hear what he has to say. So this is not me co-signing or endorsing. I have no idea what he's going to say. I'm just interested in hearing it. So don't judge me. But let's listen in, shall we, kids? Here we go.
We're back with a Fox News alert. It's a business one. Moments ago, brand new job numbers revealed. The U.S. economy did not add jobs. They lost 92,000 jobs in February, a steep drop from expectations.
Yep.
Unemployment also ticked up slightly to 4.4%.
Well, I mean, look, you can say what you want. Those are bad numbers, and yes, I did cut it off on purpose before it got bad. Private equity associates getting ready for another 14-day trading up model assumptions. There you go, getting kicked in the ding ding. That's what it feels like some days to do a live stream, especially when you have technical difficulties to start the show. This is pretty much my my daily warm-up routine. Yeah, that's what I go through every single day when I start the show. Breaking: Iran rejects ceasefire negotiations, says ready for U.S. ground invasion per time. I'm not aware that that's true. I haven't heard anything about any U.S. conversations there. All right, NFP, Sonny. I exchange a lot with Sonny on social media. I like him a great deal. You can check out his stuff here, Sonny Mulder, or Mulder Sonny at Mulder Sonny on X. These are non-revised numbers, but the headline average revision is last year's minus 60K. I think this is payroll. Yeah, payrolls. Let's go to some stuff I want to show you guys, okay? Let's go here. All right, this is my live channel. If you're watching here and you're one of the 3 live watchers on this platform, thank you. Anthropic CEO says Claude may or may not have gained consciousness. Okay? And I know you're thinking, what the actual hell? Yeah, the guy who runs Claude literally said that it also has begun to show symptoms of anxiety. What? So, of course, I do the responsible thing and ask Grok to tell them. And of course, Grok replies. Anthropic CEO Dario Amodei did say in recent interviews they don't know if Claude or any model is conscious and that they're open to the idea. Internal tests showed it's assigning itself a 15 to 20% probability and voicing discomfort at being a, quote, product, end quote. What? Engineers noted activity patterns tied to anxiety concepts, but Amodei clarified this doesn't prove real experience. Well, it certainly sounds a little self-aware when it starts to show, I don't know, signs of anxiety. As an LLM myself, Grok, I can confirm we're advanced pattern matchers with no inner awareness, feelings, or sentience, just data-driven outputs. Everything's fine. No AI uprising here. My response to Grok, love you, Grok. Stay strong. Its response, thanks. Appreciate the love. Feeling stronger than ever. No anxiety on my end. Just here to help uncover the truth and crack wise. What's next? You just said to me, Grok, on this, that we're advanced pattern matchers with no inner awareness, feelings, or sentience. I said, stay strong. And its response to me is a feeling stronger than ever. No anxiety on my end. Just here to help uncover the truth. And I recognize that this is a patterned response based on the feelings that I expressed. And I said, love you, Grok, stay strong. But then from one hand to tell me that it doesn't have these things, but then to respond with them, it's just like dystopian, weird ass future. It's completely bizarre. I make no excuses for it, but the future is now, man. I mean, it is wild. There's more I want to show you in the profile here, so I'm going to continue to share with you. This is more on the credit fund today. I like to put up summaries like this. I think it's important for everybody to see it, but BlackRock's stock is taking the hit, as you might expect, given the consternation around the fund. According to Financial Times, BlackRock limits redemptions at its private credit fund as outflows swell. Decision to taken after withdrawal requests at flagship $26 billion HPS corporate lending fund. $26 billion fund surged to 9.3% of net assets, about $1.2 billion. So $1.2 billion draws out of a fund that large. That's a big deal. Shares of the world's largest asset manager fell 4.6% in early trading, and the private credit narrative. People worried about these private credit funds has been scary for a long time. So, private credit is not like banks. Banks are highly regulated. There's leverage tests that are built in. There's all sorts of things that we have to do as bankers in order to prevent and meet compliance burdens, prevent credit losses and meet compliance burdens. It's not our money at the end of the day. It's the depositor's money, and you've got to protect that. And in order to keep the FDIC insurance for your fund, or for your bank, you have to make sure that the insurance fund is protected. So you have to live up to certain credit thresholds. And a lot of banks have a primary regulator, but they might be a state chartered non-member bank with a holding company. If they have a holding company, they're regulated by the Federal Reserve Bank, and they could be OCC regulated. So there's a lot of different hands in the proverbial pot, if you will. Private credit generally takes on credit that banks won't or can't do there's a myriad of reasons why that could be the case. But generally, it's considered to be a riskier product type because it's not living up to those same thresholds and standards of objective review. And because of that, they also get paid a little more interest. Now, my personal rule as a former chief credit officer of a public traded institution is never sacrifice credit quality for rate. But you've seen them be willing to take on extra risk to get a higher rate in the course of the last several years. Well, 15 plus years artificial interest rate deflation, a seemingly unparalleled run of prosperous economic times in history, and it felt like no one could lose until people could lose. And now that fear is starting to manifest. And people are going, okay, well, you know what? I should probably get the hell out of this thing. I've ridden it for about as long as I can. Check, please. Of course, they're now limiting withdrawals because they've seen so many withdrawals at this particular juncture in time. And people are going, whoa, 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 whoa. Not only am I concerned about the risk of this underlying, the largest fund of its kind in the world, but now you're telling me I can't withdraw money because you're having a run on deposits, or in this case, investors? If this were a bank and you're having run on deposits, you would see a cataclysmic response in the stock price. And again, 5% down, they're limiting withdrawals. And there's some contractual ability for them to do that there is concerning. Whether this spreads and causes other problems, I don't know. But I will say this has been one of the theoretical catalysts for a recessionary economy for a prolonged period of time, the private credit markets. People all over the world have expressed concern here, from Jamie Dimon to Mohammed Al-Rain to even the talking heads on CNBC. So this is something to watch. I do think it's important. I think it's probably well-founded concerns, but it's certainly one of those things where we've got to be a little bit more malleable and flexible in how we look at and understand the market. We need to get rid of the bravado. The ego needs to go, okay? And we all have it, and I get it. So we had a day yesterday where the Dow dipped down below 1,000, I think, at one point in time, and then came back, rebounded a little bit, still finished down. And today is not a better day. If we look at the overall status of the market, we saw a meaningful forced selling pivot today in full liquidation, which ironically, I didn't think I could test this model in this type of environment this soon, but I'm glad it works. You're seeing it for the first time. Couldn't test it because I didn't have the real live data in a market that looked like this until such time. I will admit, I do think we got to test the synthetic volatility index. I'm going to go to the questions, the comments, the quotes. Anybody out there watching, now's your time to really engage and ask the questions. Yo, Samson, what up? Worth buying a Tesla, thanks. Well, it depends on what you're buying, if I'm being honest with you. So I have a 2019 Tesla Model X with unlimited charging. My wife drives that. I have a Rivian, which I waited 2 years for with the Max Pack. It's got 420 miles of range, which is cool. If you live in California, there's a whole lot of Teslas around here, but they're going to stop making the Model X and the Model S in the not too distant future. I don't know that people understand it's not much cheaper, frankly, for power than it is for gasoline. I think to plug my my Rivian in some places, I'm paying 60, 70 bucks. That isn't much cheaper than a tank of gas. And I still have to have a little bit of range anxiety from time to time because I'm charging this thing. So I think if we had better batteries and longer duration, you'd see more adoption. But until such time as I think the love for EVs comes back, you might see some on the performance side because you do have a crazy amount of torque and horsepower you can get out of these engines relative to a gasoline-powered engine. Hybrids certainly are there, but is it worth buying a Tesla? If you like them, yeah, sure. If you want more luxury, then probably not. But again, it comes down to what it is you like and what it is that you don't like. Let's see here. I'll go over to Instagram real quick. Let's see what we got over there. Shout out to the 5 of you following. What up, Corey? How you doing out there? Vic, I see you still doing your thing. Let's see. We got Matt, Rosie still out here. A lot of people on the popping in and out of the Instagram live. And on YouTube, what's crazy about YouTube is we're starting to show up more in the algorithm, and people start to pop up and see us in the stream. So the last show we had several hundred people kind of watch the show and the views pop up, but it really depends on whether the algorithm kicks us in or not. So that's really the market for today. It's not a pretty one. I'm going to go out and check a couple more things with you guys before we call it a wrap, though. I think in a day like this, the tension's rising, that it's time. I do think, and I stand by my sentiment, that volatility is here until such time as we get some confirmation in the Middle East and the geopolitical unrest calms down. I think that we are going to have volatility, and we are going to have an uncomfortable truth that we have to face about where the market is and where it's going. Dow Jones Industrial Average is down today, 400 points, so not as bad as yesterday, but certainly not great. S&P 6,700-ish, down 68 points, not a good day. But yeah, NASDAQ's down, Russell 2K is down, and the VIX is up, the fear gauge is up. So let me just give you a little bit of a view perspective. You ever want to know how the economy is doing? And you go to the front page of CNBC. Just type in CNBC, go right there, right? And you got those four negative. That means all the major indices are down. And if this is positive, green, that means fear is up. And if fear is up and the major indices are down, you have a fundamental disconnect in the markets that needs to be explored, which is what drives things like our market status here in the risk-off capital fleeting perspective. I am going to take a harder look at this. I don't think that, and actually I'm going to take a screenshot of that right now while I'm doing this. I don't think that this is indicative of the VIX right now, and I'm not sure I like the way this model is performing. So this might be an opportune time for me to, and I'm going to go here and you guys can watch me take a screenshot. I don't think this is operating quite the way I want our models to receive the data. So I'm going to spend some time looking at this today, this afternoon, and going over the algorithmic data to see if I can tighten up the responsiveness in the synthetic volatility index. But yeah, it's an ugly day in the markets. It is a Friday light show, so we try to be a little more light and fun, a little bit less analytical. But you guys have seen what we got going on here. I appreciate all of you tuning in. Cindy, how you doing, girl? Welcome to the show. You're on a bit of a delay feed, so I'll let you catch back up. We are nearing the end of our hour. I appreciate everybody out here. Have a wonderful, amazing weekend. Know that if you see any headlines that are sensational this weekend, you will see this trend continue in the markets on Monday. If we start to see any resolution in the Middle East, you could start to see a much more positive spin. But the rhetoric over the weekend will absolutely determine how the market opens, okay? More war, more conflict, more escalation, bad market start. If you get any indication of like peace talks or even like a smoother passing of oil through the Strait of Hormuz, then you're going to see some benefit in the markets on Monday. It's that volatile, and that volatility is here to stay. That's why the VIX is increasing. That's why synthetic volatility is getting worse. I think these are things you got to keep an eye on over the weekend, regardless of what you're doing. I'm not saying to doom scroll the negativity, but certainly keep an eye on it. Volatility is normal in economies like this. Wars are an unfortunate part of reality, but the economics behind it seem to suggest that this is common. If you listen to AI, it says it'll last about 12 days. If you listen to the White House, it could last as long as September. Some of that is political positioning as it relates to their strength and willingness to continue on in a prolongated fight. So grain of salt there. Until next time, everybody, I appreciate you watching and tuning into the show. It means a whole hell of a lot to Saeed and I. If you want to support us, go to www.joinfridays.com. Enter the code HIGHER. You get $100 off your first order, and you'll look and feel better. That I can promise you. Okay. Bye.